Watch video 32 from the Workbook NISM Series 17 Retirement Advisor Certification Examination Final Feb 2024, and review the multiple choice questions and answers. 1. What is considered as a risky investment? A. When returns are guaranteed. B. When actual returns differ from expected returns. C. When returns are above average. D. When returns are constant. Answer: B. When actual returns differ from expected returns. 2. How is risk in an investment measured? A. By the amount of return earned. B. By fluctuations in its returns. C. By the amount of initial investment. D. By comparing it with a risk-free investment. Answer: B. By fluctuations in its returns. 3. What is taken as a proxy for expected return in uncertain investments? A. Future return. B. Average historical return. C. Risk-free rate. D. Market index. Answer: B. Average historical return. 4. What does a higher deviation from the average return indicate? A. Lower risk. B. Higher risk. C. No risk. D. Risk-free investment. Answer: B. Higher risk. 5. Which variation is considered risky by investors? A. Upside variation only. B. Downside variation only. C. Both upside and downside variation. D. No variation. Answer: B. Downside variation only. 6. In the example provided, why is the equity mutual fund with varied returns seen as risky? A. Because its returns are always lower than 12%. B. Because its returns fluctuate. C. Because it always generates high returns. D. Because its returns are above average. Answer: B. Because its returns fluctuate. 7. What does standard deviation measure in investments? A. The average return. B. The risk-free return. C. The volatility in returns. D. The total investment value. Answer: C. The volatility in returns. 8. How does a higher standard deviation affect an investment? A. Indicates more consistent returns. B. Indicates less volatility. C. Indicates higher volatility and risk. D. Indicates guaranteed returns. Answer: C. Indicates higher volatility and risk. 9. What can investors compare using standard deviation? A. Return on investment only. B. Level of risk among different investments. C. Interest rate fluctuations. D. Guaranteed return rates. Answer: B. Level of risk among different investments. 10. What does beta measure in an equity investment? A. Unsystematic risk. B. Systematic risk. C. Both systematic and unsystematic risk. D. Inflation risk. Answer: B. Systematic risk. 11. What is a key characteristic of unsystematic risk? A. It applies to all sectors. B. It can be reduced through diversification. C. It is influenced by political risk. D. It cannot be eliminated. Answer: B. It can be reduced through diversification. 12. What does a beta of greater than 1 indicate? A. The investment is less risky than the market. B. The investment is risk-free. C. The investment is more volatile than the market. D. The investment is performing the same as the market. Answer: C. The investment is more volatile than the market. 13. If a stock has a beta of 1.1 and the market rises by 10%, how much would the stock's price rise? A. 9%. B. 10%. C. 11%. D. 12%. Answer: C. 11%. 14. If the market falls by 10%, how much would a stock with a beta of 1.1 likely fall? A. 10%. B. 11%. C. 9%. D. 12%. Answer, B. 11%. 15. Which type of risk is eliminated through diversification? A. Systematic risk. B. Unsystematic risk. C. Political risk. D. Inflation risk. Answer, B. Unsystematic risk. 16. What is the Sharpe ratio used to measure? A. Absolute return. B. Risk-free return. C. Risk-adjusted return. D. Beta. Answer, C. Risk-adjusted return. 17. How is the Sharpe ratio calculated? A. Investment return plus risk-free rate, / standard deviation. B. Investment return, risk-free rate, / beta. C. Investment return, risk-free rate, / standard deviation. D. Investment return / risk-free rate, standard deviation. Answer, C. Investment return, risk-free rate, / standard deviation. 18. What does a higher Sharpe ratio indicate? A. Lower return for each unit of risk. B. Higher return for each unit of risk. C. Higher risk with low return. D. Lower return with lower risk. Answer, B. Higher return for each unit of risk. 19. In the Sharpe ratio formula, what does the risk-free rate represent? A. The average return of the investment. B. The return that is guaranteed with no risk. C. The inflation rate. D. The market return. Answer, B. The return that is guaranteed with no risk. 20. If an investment has a return of 14%, a risk-free rate of 5%, and a standard deviation of 4%, what is the Sharpe ratio? A. 1.5. B. 2.25. C. 3.5. D. 2.75. Answer, B. 2.25. 21. What type of stocks are less influenced by economic cycles? A. High beta stocks. B. Cyclical stocks. C. Defensive stocks. D. Volatile stocks. Answer, C. Defensive stocks. 22. Which of the following is an example of a defensive stock? A. Technology companies. B. Airlines. C. Healthcare companies. D. Automobiles. Answer, C. Healthcare companies. 23. Which of the following is an example of systematic risk? A. Company-specific product demand risk. B. Inflation risk. C. Management risk. D. Diversification risk. Answer, B. Inflation risk. 24. Why would investors prefer a scheme with a higher Sharpe ratio? A. It indicates lower risk for each unit of return. B. It indicates a higher return for each unit of risk. C. It indicates guaranteed returns. D. It reduces the standard deviation. Answer, B. It indicates a higher return for each unit of risk. 25. What does beta measure in relation to the stock index? A. Risk relative to inflation. B. Volatility relative to the stock index. C. Interest rate risk. D. Liquidity risk. Answer, B. Volatility relative to the stock index. 26. If an investment has a beta less than 1, it is A. More volatile than the market. B. Less volatile than the market. C. Equally volatile as the market. D. Not impacted by market volatility. Answer, B. Less volatile than the market. 27. What does a higher standard deviation indicate for an investment? A. Lower volatility. B. Higher volatility and higher risk. C. Lower risk and stable returns. D. Constant returns. Answer, B. Higher volatility and higher risk. 28. Which risk applies across all sectors and companies? A. Unsystematic risk. B. Systematic risk. C. Product demand risk. D. Revenue-specific risk. Answer, B. Systematic risk. 29. What is an example of an unsystematic risk? A. Political risk. B. Inflation risk. C. Cyclicality in product demand. D. Exchange rate fluctuations. Answer, C. Cyclicality in product demand. 30. How is the Sharpe ratio helpful for investors? A. It compares the return of an investment with its risk. B. It eliminates the risk from investments. C. It calculates the inflation-adjusted return. D. It determines the beta of an investment. Answer, A. It compares the return of an investment with its risk.